Open any financial journal today, and you'll be hit with a barrage of academic papers claiming triple-digit returns generated by deep learning trading bots. Researchers claim that complex architectures, like long short-term memory networks and massive large language models, have essentially identified consistent, predictive signals in market behavior. This chart shows a typical algorithmic backtest, but watch what happens right here at the vertical line marking live market deployment. The skyrocketing returns flatline, or worse, completely collapse the moment they hit real trading conditions. We have to ask why an algorithm that performs perfectly on historical data fails instantly in the real world. The prevailing narrative, that massive neural networks have permanently solved the stock market, is an illusion based on flawed methodology. Quantitative trading was built on rigid mathematics. Look at this mid-century IBM mainframe, the hardware that powered the very first mathematical approaches to the market. This era gave us the classical statistics bucket of predictive models. These are algorithms developed in the 1970s, like ARIMA, alongside straightforward tree-based models like random forest. On the other side, we have the modern deep learning bucket, defined by highly parameterized neural networks like LSTMs and transformers. Recent empirical reviews across the financial sector reveal an unexpected consensus. Those simple statistical models from decades ago still frequently beat state-of-the-art neural networks. Our investigation focuses on exactly why algorithms packing billions of parameters are actively losing to models with only a handful. In quantitative finance, high parameter complexity usually creates multi-layered points of failure, offering no guarantee of alpha. Financial market data is overwhelmingly chaotic and non-stationary. This photograph of a packed trading floor visualizes the reality of the market, a massive volume of human-driven noise obscuring very few actual signals. Deep learning models, specifically LSTMs, are engineered to hunt down complex, nonlinear patterns. They operate on the assumption that every single data point contains a hidden, tradable insight. This creates a massive vulnerability known as overfitting. Because neural networks are so computationally powerful, they often end up memorizing random market noise instead of finding the underlying trend. Classical models like ARIMA structurally resist this trap. Their rigid, linear constraints prevent them from memorizing random fluctuations. In financial markets, an algorithm that fits the historical data perfectly is almost guaranteed to fail at predicting the future. To measure whether adding a complex algorithm actually improves accuracy over a simple baseline, institutions use a strict framework called forecast value added, or FVA. This chart visualizes the results of a comparative study by Yamak and colleagues, testing different models on Bitcoin price forecasting. We start with the baseline error rate, mapped here in gray. Adding the complex LSTM model drops the error to 3.97%. But the classical ARIMA model drops noticeably lower, hitting 2.76%. Bitcoin contains strong linear price components, hidden inside its extreme swings. By applying the heavy, non-linear complexity of a neural network, you actually generate negative forecast value added. Objective performance measurement exposes how unnecessary mathematical complexity actively destroys a trading strategy's baseline edge. If classical models win in live FVA testing, how do academic papers continually publish peer-reviewed studies claiming 500% returns using large language models? A recent study by Coelho y Silva isolated the fatal flaw contaminating modern AI financial research: data leakage. This timeline tracks the life of a typical LLM. The vertical red line marks its pre-training cutoff date, say 2021. Notice these dashed lines leaking backwards. These represent continuous fine-tuning, ingesting updated global data streams. Researchers unknowingly test these fine-tuned models on historical backtest windows that the model has already implicitly ingested during those updates. The LLM isn't predicting the 2022 market in the backtest. It is simply recalling the 2022 data it was already exposed to. This creates artificially inflated out-of-sample Sharpe ratios and profit curves. The alpha looks massive on paper and evaporates the second it touches live trading. An algorithm trading with future knowledge is merely reciting history. Despite these flaws, institutional hedge funds are spending billions on AI infrastructure. This wide view of the Tokyo Stock Exchange represents a highly capitalized environment that does not waste capital. The technology has immense value, provided it is applied correctly. Major institutional funds reject end-to-end deep learning for price prediction. Instead, they use large language models strictly for feature extraction. A study by Gupta and Yan illustrates this architecture. On the left, an LLM ingests 18,000 unstructured regulatory filings. On the right, it outputs streams of structured numbers. It extracts nonlinear narratives, like supply chain risks, and converts them into bounded numeric variables. The true institutional edge lies in using transformers to read the complex context of the world, rather than forcing them to guess the future price of a stock. The final step in this hybrid architecture is feeding those AI-generated risk variables alongside standard price data directly into a classical statistical engine. Battle-tested frameworks like LightGBM or ARIMA use these rich, text-derived features to execute trades, maintaining total structural stability in the face of chaotic data. This isolates the unique strength of transformer networks, their natural language processing capabilities, while relying entirely on the rigid risk management of classical mathematics. Final takeaway: in the zero-sum game of quantitative trading, complexity for the sake of hype is a liability. True alpha is found where cutting-edge